Larry McMillan. Now, Larry is the founder of, hold on for a minute. Larry is the president of McMillan Asset Management and McMillan Analyst Corporation, which he founded in 1991. He is the best-selling author of Options as a Strategic Investment, which was originally published in 1980, and it's currently in its 5th edition. It is the Bible for options traders. His distinguished career has taken 2 simultaneous paths. One is a professional trader and money manager, and the other is a widely respected educator and proponent of using option strategies. In today's presentation, Larry's going to be talking about the Vix SPY option strategy. And more specifically, this is a favorite hedging strategy of his for high volatility markets. I think we can agree we're in high volatility markets. He's going to share how to realize sizable profits regardless of the market direction and examples of this strategy performing in today's markets. So with that, it's my pleasure to welcome Larry to the room, who will be kicking us off. Good morning, Larry. How are you doing today?
I'm good. Can you hear me all right?
I can hear you just great.
All right. I don't have a camera on. That's not a problem, is it?
No, that's not a problem whatsoever. We just need to see your presentation.
Okay, so I click share screen, right?
Yes.
Okay. So we're going to talk today about this one particular volatility strategy that we've used in volatile markets, really going back to 2008. And it's an excellent strategy. I can't say that it's simple, though. So luckily, as Riley said, there will be a recording of this seminar, and we'll also make the PDF of this presentation available to you as well. So let me get started here. Our company, just to give you a little background, we started out as a derivatives research firm almost 30 years ago, and after I came off a career on Wall Street. And then we branched out into money management about 12 years ago, and we also do some option education, things like this, and mentoring. Our accounts, our money management accounts, are positive on the year. We were positive even in March, especially in March. Now, I'm sure there's other accounts that are positive on the year with the market bouncing back like it has. But our newsletters have done very well also, and we'll be offering you a free subscription for 30 days to our Option Strategist newsletter, which is in our 29th year of publication. All you need to do is go to that link, optionstrategist.com/TP free, and you'll have the opportunity to be a subscriber for 30 days. We're not asking for a credit card or anything. Okay, so we're going to be talking today. I want to just start with the basics, VIX, then we'll talk about VIX Futures, what the term structure means, what the ETNs mean, the big one, of course, on that being VXX, and then a strategy called the Big Volatility Short. Then we'll talk about VIX options, and I'll finally get to the strategy itself. So it's quite a bit of stuff. Let's get started. So implied volatility, when you're trading an option, the part of the option's price that is not intrinsic value is called time value, but that's probably really a misnomer, because as volatility increases or decreases, or expectations of volatility increase or decrease, that's going to change the price of the option. So when implied volatility is low, we say options are cheap. When it's high, we say they're expensive. What causes it to get high? Well, bear markets, large price drops, takeover rumors in certain situations, FDA hearings, and of course, in this market, a biotech virus kind of candidates as well. Vix invented a volatility index, or the ZBOE invented Vix, which is a volatility index, in 1993. It's gone through a couple of changes. The most modern one now was changed in 2014, but basically it looks at SPX options and comes up with a 30-day estimate of volatility based on what people are paying for SPX options. So heavy put buying usually makes the index go higher, and it is certainly higher these days. In fact, over time, it's gone higher on some very nasty conditions in the market. For example, VIX, as I said, wasn't created until 1993, so that's this line right here. But the CBOE backdated its formula to 1986 so that they could get the crash of 87 in there, and VIX, they estimate, would have gone to 150 during the crash of 87. We know that it went into the high 80s in 2008, and then just this time it went into the low 90s. I'm actually showing VXO here, which is the original VIX, but VIX itself is very similar. And you can see many other times during the life of the market when you had these extreme down moves in the market cause a big spike peak in VIX. And we're still in this one right here. I'm going to show you a little bit better chart. Here's the current chart of VIX. And all those B's on there are buy signals. We have an actual trading system we based around that. I'm not getting into that one today. That pertains in really any market. But one thing that did happen, and this is something to keep your eye on, back here in February, before the market actually broke down, VIX crossed above its 200-day moving average. This is the 200-day right here, and this is the 20-day. VIX crossed above the 200-day, and the 20-day crossed above the 200-day. In that state, that's bearish. That happened on February 21st. So the market didn't break until the 24th, or it might even happen on February 20th. I can't remember exactly. So you got a heads up right there on a gap up in VIX, and then of course the whole thing went crazy after that. So we're going to be talking about the strategy we were in mostly in this area here when VIX really got crazy. So you can't trade VIX. It's a very complicated formula, but there are futures on VIX, which were created in 2004, and there are options on VIX which were created in 2006. I would say most people don't trade these too much, or if they're trading, maybe options on VIX, but perhaps just options on VXX, which we'll get to in a minute. The CBOE publishes other volatility indices, but you really can't, they don't have products that you can trade on them in most cases. So VIX futures they're $1,000 a point. So right now, if you buy a VIX future, it says trading at 37 and it goes to 38, you've made $1,000. The margin jumps around on these things. I think it might be higher than that at some brokerage firms. Obviously, the brokerage firms can charge what they want in terms of margin. The last trading day of the futures is always a Wednesday, and they settle in the morning. It's sort of an odd thing, but I'll show you how they get that settlement date in a second. There are futures contracts going out 10 months usually, and also weekly futures going out about 6 weeks. So these will all be important. But as far as that expiration date, if the July VIX futures are going to expire on July 22nd. How do they get that date? Well, they look at the regular SPX. Remember, the regular expiration will be the third Friday of the month in August. So the third Friday of the month in August is August 21st. If we back up 30 days, that means we back up 21 days in August and then 9 days in July. Since July has 31 days, back up 9, it gets us to 22. That's the expiration date of the futures. And the reason being, VIX is a 30-day index. So for market makers to be able to hedge VIX futures, they need to trade options that are 30 days out. That would be these SPX options. That's what they use as a hedge. If you don't give the market makers some way to hedge, then you won't have any depth to your markets. You won't have any liquidity. So the weekly futures came along in 2015, and they also are a 30-day look forward, and there are weekly SPX options as well. So those are the options that pertain to those. So every week there's a VIX expiration on Wednesday, and you can find out that settlement price by looking at the symbol VRO. Most people don't, in fact, I'd recommend that you not hold all the way into expiration. I'll show you an example at the end of how that sometimes doesn't work out so well. So the reason that we're talking about the weekly futures, though, is that the nearest term product, whatever it is, in this case weekly futures, will adhere most closely to the price of VIX at all times. And there's reasons for this. We'll get to those in a minute. But these VIX weekly options are based on the price of the VIX weekly futures and not on VIX itself. Again, I'll show examples. But I want to start out just with the general concept. If you look at the price of VIX futures, you might see that their price, here's like the near term and then the next term, and then it might slope upwards like that out in time. That's called the term structure. And I've heard people on TV say, oh, the reason that the November futures are trading at a higher price is because the market makers expect VIX to be higher by November. That's patently false. And people who are like supposed option experts on TV are saying that is ridiculous. Here's what's really going on. Let's say, just as an example, in this example, let's say VIX is cheap. VIX is around 13. In a bull market, that would kind of be the case. So if you come to a market maker and say, look, I want to buy a 1 week option, how are you going to price it? And he would say, all right, well, I'll price that at a 13 volatility. So that's what I'm pricing it there. But if I come to him and say, look, I want to buy a 3-year option, where's he going to price that? Well, he has no idea where volatility is going to be in 3 years. So he's just going to use the average volatility, which let's say is 25%. And this is where he's going to price the 3-year option. So we get a 1 week option price with a 13 volatility and a 3-year option price with a 25 volatility. Now the VIX futures trade, that's what those numbers are, the volatility. So then another guy comes in and says, look, I want to buy a 1 month option. How are you going to price that? Well, VIX is 13, and I know it's a little vague about what's going to happen to volatility in a month, but I'll probably price it around 15. So I'll say a 1 month futures contract based on a 15 vol, or a 1 month option based on a 15 vol. But if you want a 2-year option, I, again, don't have any idea where volatility is going to be in 2 years, so I'm going to price it just a little bit less than a 3-year option in terms of volatility. And finally, the ones in between. So what happens is the near-term option is the cheapest, and as more uncertainty creeps in because of the longer time frame, the prices of the futures rise out to where the average volatility exists. So that's why the term structure slopes upwards. It has nothing to do with market makers trying to predict where volatility is going to be, 6 months, 8 months out. Now, in a bear market, this happens, and this is a situation that we're seeing now. VIX very high, so the near-term futures are highest. They're closest to the price of VIX, again, because the market maker might price it there. But the long-term future is still the same price, 25. And due to uncertainty in between, the term structure would slope downwards like that in a bear market. So here's some examples of how the term structure evolved and how the various futures behave in extreme bear markets. So this is 2008, and the various colored lines are pertain to the dates here on the right. So you can see in August of 2008, you may not recall this, but the market was fairly calm. VIX was 20, and the term structures were priced slightly higher. Not a lot higher, but all the way out to February, that was trading at 23. But then things started to fall apart, and the Lehman Brothers news broke on September 15th. But it was actually starting to get crazy even before that. And as the market collapsed into that huge bear market there in October of 2008, VIX itself shot all the way up to 54. Now, the VIX futures, you can't trade VIX, remember. So the best you could do is own the September futures. So that would be like you start out here and you ride the September futures up here until they expire. Then you have to jump over to the Octobers, you ride those up the rest of the way. So they didn't move as far as VIX, but that's the best you could do at the time. That was the shortest term instrument available then, the near term VIX futures. And you can see that if you had bought those, you would have gone from about 21 to 42. You had a pretty nice profit. And you would have hedged a lot of the loss in your portfolio, or you would have made a lot of money if you were speculating or whatever. But if you were just out here in February, which is only a few months out, 4 months out, you can see that it went from 23 to 29. So in the biggest financial crisis that we'd seen up to that time, you make 6 points on the futures. That's not worth it. So you need to stay short term to have any chance of performing anywhere close to what VIX is doing. And so again, you'll hear people sometimes say, well, I expect volatility to be higher 4 months from now, so I'm going to buy the 4-month future. That's not the way it works. You know, if it doesn't increase until exactly 4 months from now, fine. But you need to stay short term and just keep rolling your contracts over. That will give you the best chance at performing like VIX. Now, the VIX weekly futures came along, as I said before, in 2015. And right after they did, we had a very nasty drop in the market. One Monday morning, SPX fell 9%. VIX itself rose 167% on that day. And the front month VIX weekly futures rose 147%. So here's the front week future, actually, is what happened is, so this is VIX, the yellow line, or whatever, brown line. The blue line is the front month future. Here's the here's the VIX September future. So you can see that the weekly way outperformed the first month and the second month also. So again, now that weeklies have been introduced, the best performing future in terms of rising when VIX rises is the shortest term weekly future. This is what happened in December 2018. Again, crazy market, as you recall, we dropped very heavily down into Christmas. It was a very bad Christmas, actually, for a lot of people. Wasn't a good time there at all. The CBOE publishes a 9-day volatility index. You can't trade that either, but it shot up here to 43 or so. VIX itself went to like 36. The front week future went also to 36 because it was expiring right just a couple of days after Christmas, but I think the day after Christmas. So they have, the weekly futures have the number of the week in which they expire, so that would be the 52nd week of the year. And you can see that, you know, even the next week's future did all right, but you start to get out into the monthly futures here and here, they didn't perform well at all. So again, same sort of thing. And then this year came along and we saw things that we really hadn't probably ever seen before in terms of the craziness of the markets and the discounts. For example, on March 16th, which was one of the very bad days in the market, VIX was 78. The March VIX futures, which are going to expire 2 days later on March 18th, were trading at 70.65. So almost an $8 discount. $8, you know, is in fact exactly $7.85 discount between VIX futures and VIX. Then if we looked out the next week, trading even lower, the next week even lower and lower and lower. So the term structure here is just sloping monstrously downwards like that. And so while it might be interesting to think about, well, I could buy this one, you know, it's going to have to catch up to the price of VIX eventually. That's too far out in time. Too many weird things can happen. But so, you know, we're trying to concentrate more on staying in the shorter term here to set up this hedge strategy that I'm eventually going to arrive at. So again, though, in this particular situation, you'd want to buy the 1 or 2 week VIX, the first two out. VIX 12th week is the March 25th futures, and VIX 13 is the April 1st futures. Again, obviously they started out very low, started out around 12 to 15 in February, and here they are in March at, you know, monstrously higher numbers. Now, both speculators and hedgers are sometimes disappointed that you don't get that full move in VIX like we just saw. Why does this happen? Well, basically, in a time of panic, someone is looking to buy protection. They're going to buy the shortest term protection they can. And remember, in terms of their protection, they're probably buying SPX puts. But all of these VIX futures are priced, you know, and VIX itself are based on the price of SPX options. Let's say you're a trader and your VIX is starting to collapse, you're starting to panic, and you look at the SPX options and you see the one expiring next week costs $4, and the one expiring in a month costs $14. You say, well, I'm buying a $4 one. Even though it probably has a higher implied volatility, you don't really care about that at that point in time. You're trying to buy the cheapest protection you can, and then you'll worry about it when it expires. Do you need to buy more protection? But that's what happens here. They buy the shortest term product. So in 2008, the shortest term product was a 1 month put. Nowadays, it's a 1 week put. And so that's why the near term ones trade at a higher price in terms of implied volatility than the longer term ones, because there's demand for those near term ones. So the term structure itself can be traded, and this is one trade that you might want to take note of. Remember, we said in a bear market, the term structure slopes down like this. In a bull market, it slopes up like that. These are futures prices. So if we're bearish, when the term structure is sitting here and we expect it to slope get to that slope, there's a trade we can do, and bullish similarly. So the futures exchange, which these all trade on the CBOE futures exchange, CFE. And by the way, you can get the price of all the futures just by going to cboe.com. And on their homepage, it shows all the weekly and monthly futures in the upper right-hand corner. It might be delayed prices, I'm not sure, but you can certainly get the idea. So we're going to trade the term structure here by trading a spread between the two front months, or first and third month. And if we're bullish on the market, we want to sell the front month future and buy either the second or third month. If we're bearish on the market, we buy the front month future and sell one of the other two. So let's look at an example. This goes back to the summer of 2007. It doesn't really make any difference. That's when the first warning signs about credit crisis had happened, and the market dropped sharply. So we had VIX trading here at 27, then the first, again, in those days, monthly futures trading there, then here, then here. Now this is on the 17th, so September futures were just about to expire. So you can see the term structure sloping steeply downwards, and we're going to do a bullish trade here. So if we do a bullish trade, we sell the front month and we buy the next month. That's a bullish trade in bullish on the stock market, but using VIX futures. And as you can see, a week later, the market did rally from SPX 1476 to 1518. The one we're short made this much money. The one we're long lost less, and so we had a nice trade. Specifically, here are the prices on the 17th, the day we put it on. What the October futures were trading at $1.50, 1.50 points higher than the November futures. You don't say that's a credit. That's not the way they say things in the futures market. You just say you're buying November, selling October at 150 to the sell side, or 150 October, November. Anyway, a week later, you can see this is the one we're short. It's dropped that much, and this is the one we're long. So we made the spread went from plus $1.50 to minus 21. That's all in our favor. That's $1.71. Remember, these are $1,000 a point, so that's $1,710. And if we stuck around for another week, it even got better. Now, what's the margin on these? Well, originally it was $50 margin for that trade. Then they raised it to $625, which is still ridiculously high leverage. Now they've gotten a little more reasonable. The margin, I think, now is, or it changes. The CBOE publishes the minimum margin requirement, but it's around $3,000. So still, you make 50% on your money in a week. That's a highly leveraged trade, so be careful with it. But if the next time you have an opinion bullish or bearish on the stock market, you might want to think about trading the term structure instead of just buying, say, overpriced SPY calls or SPY puts. So the risk here in this trade is unlimited. Those two futures could widely invert on you. And so you want to be sure that you have some stop in mind. Basically, if you're putting up $3,300, how much can you lose before you really feel uncomfortable? I mean, it's a highly leveraged trade, but say maybe it's $1,000. So you would want to stop yourself out. We put that trade on at $1.50. If it widened out to plus 250, then stop yourself out. So you need to stop yourself. You can implement this with ETNs or with options on VIX, but you lose all your leverage then, so it's really not that good a trade if you do that. is there a way to hedge the trade? Well, yeah, let's say in that case, we were putting on a trade that was bullish on the stock market. So we might buy some SPY puts to hedge ourselves. You know, it's possible. I don't really do that normally when I have that trade on, but it would be a hedge. Anyways, so you could hedge your portfolio with this too. I mean, for example, this year on February 24th, the market broke down. You could have put this trade on to buy the March futures and sell the April futures. Now, in that case, we're buying the front month and selling the second month. So that's bearish for the stock market. But we're putting this on as a hedge against our long stock portfolio. And we did, in fact, for our managed futures accounts, put this on for 60 cents and exit it later for 12 points. That's $11,400 per spread. How many spreads do we do? We typically do one spread per $50,000 of notional value being hedged. So if you just own stocks, and that's the price of your stocks. If you're short puts, you want to hedge the entire notional value of your puts, which would be your strike times 100 times how many puts you're short. Okay, so another product that we sometimes use is an ETN, VXX. So VXX was created in 2009, just before the market bottom, and it's been wildly popular. It trades, well, the last time I updated these volumes, was trading 17 million shares a day. It uses the 2 front month Vix Futures as its underlying. So all of these volatility ETNs and ETFs use the Vix Futures as their underlying, which is something I'm pretty sure not everyone is aware of. And it turned out to be disaster for some people, as we'll get to that in a minute. Then, since that was successful, competitors came along like VIIX, VIXY, etc. And then the reverse ones came along, XIV and ZIV. XIV has since been delisted. I'll show you why in a minute. And then right now, the existing reverse one is SVXY. So you can still short volatility by trading SVXY. Then they came along with one that was wildly popular, TVIX, double the speed of VIX. But this one is being delisted. So if you have a position in it now and you're not aware of it, that delisting, get out of your position right now. Do not stick in this thing till the end. There's a very nasty wind down in this thing. Credit Suisse is the market maker, and they've got some bizarre plans to get out of this thing. So do not trade this thing. If you're in it, get out of it. That web link I have right there is a great article about what's all going on in that. I'm not going to go into it, but just there's no longer a viable double VIX, or that one is no longer viable. So an ETN is a credit, and an ETF is a basket of securities or futures or whatever that is put in escrow. An ETN is essentially subordinated debt of the company. So VXX is issued by Barclays. Barclays is a huge bank and, you know, has earnings of like $1 billion or whatever. But, you know, Bear Stearns went broke. Other banks can go broke too. So you really, while you're trading at VXX, you're in the subordinated debt of that issuer. That's not normally a problem. The only ETFs are VIXY and VIXM, but they perform exactly the same. And so if you're ever worried, you can go onto Bloomberg, type, let's say TVIX, type that in today as your symbol, and it'll show you the net asset value. So last night, the last sale on TVIX was 147.29. The net asset value is lower. It should be the same. So not much lower, but that's a warning sign right there. If they're not the same, something might be going on. And as this drags towards the end, probably the net asset value will rise. The last sale will rise above the net asset value. And it's just a matter of, it's going to be very difficult to get your net asset value out of this thing. So let's look at VXX, because that's the popular one in a little more detail. They have the 2 front months, and the percentage of each holding is adjusted every day. So this is the same way VIX is calculated. So let's say today you're 90% in VIX July futures and 10% in VIX August futures. So that's the current makeup. At the end of today, they need to change that. So now it might go to 85.15, and then tomorrow 80.20, etc. So every day, Barclays, who's the market maker, has to sell some of the near-term futures and buy some of the second. They only use the monthly, so they sell the front month and buy the second month every day. And so for a while, the market maker was kind of ripping them off on that trade, but eventually they came to an understanding. But this causes performance discrepancies versus VIX. So in 2010, we had a nice bull market going on, and the term structure sloped upwards like this, and everything was wonderful. And VIX itself was just calmly staying down here in this area. Meanwhile, VXX was getting killed because of that daily roll. And again, same thing here a little bit later. VXX getting killed, even though VIX is staying flat. But then in August of 2011, we went into a bearish market, a pretty nasty bear market. VIX jumped up to this level and then stayed flat again. But this time, because the term structure had inverted, now Barclays gets to sell the higher one and buy the lower one, and that causes an outperformance for VXX. So in a bull market, which we're in most of the time, VXX will underperform VIX. And in a bear market, it will outperform VIX. This is XIV that we just traded the exact opposite. As I said, this doesn't exist anymore, but I'm going to use it as an example. So XIV, again, during the bull market, it outperforms, and during the bear market, it underperforms. So SVXY is the short volatility index now, and it also has that same characteristic. So there's also a quirk to this. Sometimes you may be short VXX might be preferable to being long XIV, but most people didn't do that. So people got into the mode early on of realizing that VXX underperformed in a bull market. So professional futures traders back in 2004, 2005 were shorting VXX and just shorting the VIX futures and just covering them on the decline. Now the public couldn't do that; it's too complicated. But in 2009, when VXX came along, they could. So they could short VXX and make a lot of money when it declined. Now you don't want to stay in that position forever, but you can stay in it as long as the term structure slopes downwards. When the term structure flattens, then it's time to get out of that short trade. But here's how the big volatility short looks. If you had traded, now they've reverse split VXX a lot of times, but it's lost 99% of its value from the day it was issued to, well, wherever eventually, I'm going to say 2017 or so. And there are some big rallies in there. 2008 there was 2010 there was a big rally in the flash crash. A rally in VXX takes place during a bear market. There was, of course, 2011, that August thing, and then, of course, what happened now. So this is what VXX did in the last 2 years. For most of the time, well, 2018, it shot up in the beginning of the year, and then, it went down. Then we had that bearish market, and then in the fall of 2018, then a big bull market through all of 2019 into the early part of this year, and then complete explosion on the upside. And if you short that thing, it's wonderful when it's going down and not so wonderful when it's going up. So you have to watch the term structure and get out of your short sale. Now, what happened to the inverse, the XIV? Well, remember the XIV or any other product like that, it actually has these short futures to it. So you were XIV, you were short VIX futures. So if they actually doubled in a day, this thing would go to zero. And we wrote articles about that and trying to warn people. People didn't pay much attention, you know, because they were making a lot of money in XIV. Look where it went. It went from, you know, below 20 to 150 prior to February of 2018. February 2018, the market took a huge whack, and on this particular day, Vix Futures doubled. And so you can see this thing was dropping, and then it dropped a year. At which point the underwriter, who I believe was also Credit Suisse, decided to bail and got out of that thing. And so it was delisted. But you can see the danger in shorting volatility. And this is the way, there were so many people in this trade, you know, relatively unknowledgeable people were long XIV and did not get out. What happened was about right in here somewhere, the term structure inverted in the VIX futures. And that was your sign to get out. But no, they stayed. And even some hedge funds, guys who have supposedly known better, were crushed in that trade as well. Now they have watered down these things now, so SVXY that's the current thing you're short, and it only moves at half the price of VIX. But still, a 200% rise in VIX futures would still wipe that out. And you say, well, how likely is that? Well, I'm just going to tell you, in the crash of '87, VIX was up about 5 times in one day. So it's possible. So again, if you're shorting volatility based on being long SVXY, get out when the term structure inverts. It's just that simple. So options on VIX came along in 2006, and they're very similar, you would think, a cash-based option, blah, 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 all that kind of stuff, but they don't trade like you might think they would. So here's how they traded on day one. I want to just show you this example because it illustrates what's going on. And on this day, VIX was trading at 1146, and I want you to just look at the price of the 15 strike puts. That's these guys here. So you're looking at there, and you see, the March 15 puts trading for 3. You say, well, wait a minute, what's the, you know, intrinsic value here? VIX, the strike is 15, and we subtract off the price of VIX. And that's intrinsic value, and that should be, you know, all the options should be trading higher than that. But I see the March contracts trading for 3. That's very weird. And then April's trading for 255, and May is trading for 2. At this point, you can't take it anymore. You jump in, you buy some May puts, and you know, as you're discussing the trade with your broker, he says, "Oh, by the way, you know these things price off the futures, right?" Click. You say, "What? What did he say?" Well, they do price off the price of the futures. So this is one of the few option products where the supposed underlying price has no meaning, none. This is what they're pricing off these futures here. So if I told you XYZ was trading at 1386 and the May 15 put on XYZ was trading at 2, you wouldn't think that was unusual at all. Intrinsic value is $1.14. Puts trading at 2, everything seems normal. And everything is normal once you realize that the futures are the underlying for these various futures contracts, are the underlying for these various option contracts. And so that's very important because weird things can happen in crazy markets. This is October 2008. VIX went to 70. And if you looked at the 25 strike calls on VIX, you saw these prices. October was 3160. Now, you know, this is the difference here is 45 points almost. And this call's trading for 31. This one's trading for 13, and this one's trading for 10. And now you're saying, like, all right, you're kidding me here, right? What's going on? But if we look at where the futures were, it makes a lot of sense. The futures here were trading at big discounts, just like I showed you earlier. So if the 25 is the strike and the futures are trading at 56, then that's 31 points in the money, and that's right where the option was trading. Meanwhile, the term structure was sloping steeply downwards. So November futures were at 38. So a 25 strike is only 13 points in the money. That's why that's trading at 13 and change. And then the December futures even lower, trading at 33. strike at 25, the futures have a little time, the options have a little time value trading at 10. So even though that looks completely illogical, you have to understand that it's the futures that are determining the underlying for the option prices. And this is extremely important, because if you were trying to do something like a calendar spread, and this actually did happen, people bought a calendar spread. It was recommended by someone, not me, but they had put in a lot of positions that think or swim without understanding what was going to happen. Buy this call, sell that call. If it was IBM, you'd just be risking the 40 cents here, but it wasn't IBM. We just saw that call went to 31 and this call went to 13 on the previous slide. So this spread inverted. It went from plus 40 to minus 1830. You lost $1,870 on every spread. And the brokers weren't margining it right, and it was a huge problem. And so at that time, Thinkorswim banned trading in the VIX options for a while. And now, if you do that spread, you have to margin the short side as a naked call. There's no hedge. Anyway, all right, we just had that same thing. Let's go on to something else. All right, so the strategy that I really want to get to is the VIX SPY. So we're doing all right. Here we got till 11 o'clock. And there's a couple of ways you can trade VIX versus SPY. One is with the calendar spread in the VIX futures, which we saw earlier, or that was what I was calling trading the term structure. But the other one is to trade with options, SPY and VIX options. And really what you're doing here is a variation on buying a straddle, but it's also heavily dependent on the discount in the VIX futures. So in extremely bearish markets, which is what we had in March, the futures traded at large discounts to VIX. We saw that. October 78 in this example, VIX was 70, the near-term future was 56. Now these two are going to have to become each other, because at expiration, there's a settlement. Remember I told you the VRO is the settlement for VIX futures at expiration, and that's going to be near the price of VIX. Not exactly, but close to the price of VIX. So they're going to have to come together. But how are they going to come together? Is VIX going to drop 14 points more than the futures, or are the futures going to rise 14 points more than VIX, or are they going to meet in the middle? It's very hard to say. No one knows. So we would like to do a hedge. And so we want to, if we're dealing with this big discounts, which we have in bear markets, we're going to buy calls on both SPY and VIX. In a more wildly bullish market, you can do it the opposite way around. You buy puts on both. But this is the strategy we're going to be looking at. Now that's hedged, because as SPY goes up, VIX goes down, and vice versa. So owning calls on both is a hedged position. As I said before, we don't know whether the VIX is going to move to the price of the futures, which in that example would be dropping from 70 to 56, or is it going to be the other way around and the futures are going to move to the price of VIX, or somewhere in between? So what we're going to do, you could do this with futures, by E-mini futures and by VIX futures. That is a strategy that we use in one of our pure futures managed accounts, but it's much higher risk than you might think. If we just buy calls on both, we know what our risk is. We pay for the calls. We can't lose more than that. And usually, the right formula is to buy 2 VIX calls and buy 1 SPY call. That's usually the correct ratio. Sometimes that ratio changes. I'll show you in a minute. But so what do we really have here? If the market moves a huge distance, the one call will go to 0. The other call will make a lot of money. Let's say, for example, the market goes way up. That SPY call is going to make a lot of money. The VIX calls are the VIX will go down if the market went way up. Those VIX calls might expire worthless. But way up makes us money. How about if the market went way down? Well, that SPY call will become worthless. But if the market goes way down, VIX is going to rise. On a little movement down, it might not, but on a big movement down, it will. And so those VIX calls will make money. So again, if the market makes a huge move in either direction, we're going to make money. So that's the straddle part of it. But the edge part of it is that we're going to put this thing on when we have this large differential between the price of the VIX futures. And remember, VIX calls are, their underlying is a VIX future. So we're buying calls, let's say with a strike of 56 here, when VIX is 70, and somehow or other this is, that's our edge, because the VIX calls, if the market goes, if the VIX goes up, then we have a boost to the upside, and if VIX goes down, we have a cushion because it's still below the price of VIX. So in a deep discount situation, the term structure slopes downwards, as we saw earlier. And you might, instead of doing VIX calls, do VXX calls, but I'm not going to really get into that here. You can pick and choose. So I'm going to show you one example from a few years ago, and then the current example for today. So I'm sorry. So here this is when SPX dropped like 9% in one day. I really hadn't seen that in a long time. VIX was 40, and the front month futures were 24. So it's huge discount of 1674. The October futures were even lower. So in this particular one, we bought VXX calls and SPY calls. And in fact, we bought in the ratio 2 for 1. And so this was the prices we paid that day. We bought two calls at 424, one call at 630. That's a total debit of 1478. A week later, SPY itself had actually risen a couple of points, but volatility kept increasing, and that's what we've seen in the current market too. And so a week later, the two calls that we bought at 424 now trading at 685. The one call we bought at 630 is trading at 660. So therefore they add up to 2030, and we exited the trade. So we got in at 1478, got out at 2030. We probably could have done a little better because we paid a lot of implied volatility up here when we bought these options, but in reality, we usually scale into these trades over a couple of days. But let's get more modern. Let's look at what happened. This trade has worked on many times. The best times have been the huge down markets, October 2008, August 2011, February 2018, and then March of 2020. What are the considerations you have when you're in this trade? Well, you want to keep your deltas neutral if possible. I'll talk about that in a second. If one side starts to move a lot, I'm always in favor of locking in some of your gains. Let's say you own a call and the stock goes up. Forget whatever it is, IBM, anything. If it goes up, consider selling the call you're in and buying one at a higher strike. So you're still in the trade, but now you take a big credit out when you do that. And or you could also use a trailing stop. I'll show you how we did this. Now we exit this trade on those conditions, or also if the edge disappears. So if VIX comes back down to the price of the futures, roughly equal to the futures, then there's no more edge in the trade, and we would get out. This is actually the formula that you would go through to calculate the neutral ratio, but units of trading are 100 for both VIX calls and SPY calls. And if we buy equal deltas on both sides, this factor falls out as well. And so we're left with just this little formula. So just as an example, let's say your October VIX futures were trading at 34, SPY was at 112. You need to know their volatilities, which you can get off our website for free, by the way. And then you do the little formula, we come out 0.5, which means buy 2 VIX calls and 1 SPY call. All right, so once we're in these trades, we're looking at them every day. We don't just slap this thing on and walk away from it. These are some of the things that we take into consideration when we're trying to decide, how to adjust this position. But I'm going to take you through specifically a trade that we did in our managed accounts, and in our newsletter too, we had these trades, several of them. They performed excellently. So on February 28th, which is the end of the first week of the breakdown, remember the market broke down on February 24th. So at that time, VIX had increased to 39. The front month March futures, which were expiring on the 18th of March, so, not too, just 18 to 19 days after that, 29 days in February in 2020. And SPY was trading at 305. So we had a 13-point discount here in the VIX futures, and SPY is trading at 305. So the ratio by that last formula I showed you was 3-2. So we're going to buy in the money calls on both sides to keep the delta kind of equal. So with VIX futures trading at 26, remember the futures are the underlying for the March options, and we're buying the 23 calls. So the underlying is 26, and we're using a 23 strike lower. That's in the money. On the other hand, on SPY, we're going to do the same thing. SPY is at 301. We're going to buy SPY is at 305. We're going to buy a 301 call, also in the money. Now that increases our initial investment in this thing, but also it decreases the time value premium risk, because there is time value premium and risk here. We're buying all these options, and if they all went to parity, we were going to lose a lot of money on this trade. So we start out, that investment for that trade is $35.60. Not a lot, and not crazy. $35.60. I'm not like asking to put up $35,000, $3,500. So 2 days later, was over the weekend too, I guess. The recalculate the ratio, and the ratio is actually now 3-1. So we sell off one of the SPY calls. Remember, we were 3-2. We had 3 VIX, 2 SPY. We're going to sell off one of the SPY calls. We got $8.80 for that. These are actual prices that we actually really did those things. And this left us long 3 of those VIX March calls and long 1 SPY call. The end of that week, now VIX is continuing to rise. VIX gets up to 46. The VIX futures still lagging behind, a 10-point discount now, and SPY still falling. SPY's down to 295. So now our VIX calls, remember we bought the 23 calls when they were 3 points in the money. Now they're 13 points in the money. So that's a lot. We're heavily weighted now to long delta on VIX. So we're going to roll up. As I said before, we do this a lot of times when the options get in the money. We're going to roll up, take a nice credit out of the position. So we're going to sell those 23 calls, the 3 of them, the March 23 calls, and we're going to buy 3 of the March 40 calls. And in doing so, we took in 11 points credit for each spread, and we have 3 spreads. So now we just took in 33 credit there. Now, just a couple of days after that, VIX is 49, and VIX futures are 42. So the discount is shrinking. It's, remember, started out at 13 and 10, now 7. And SPY is dropping like a rock down to 275. So those SPY 301 calls we have, they're not really hedging anything. And remember, these futures expire on March 18th. So I'm trying to still capture the 7 points of time of discount that's in there, but I need a hedge. And those 301 calls are not hedging me with SPY at 275. So we rolled down, and this is, I would say this is a sophisticated part of the trade. Probably we wouldn't do this unless you really felt confident, but we feel confident in the hedge. And I need the hedge. Otherwise, I'm just long VIX calls, and that's too crazy, So we rolled down from the, this should be 301 calls down to the 253 calls, and paid a $31 debit to roll down there. But now we have the hedge back in place, 3-1 hedge. And just a couple of days later, now market's collapsing, VIX is exploding, VIX is 70. The futures are now 53, so now the discount's back to 17. SPY is 250. The ratio is now back to 2-1. So we're going to sell off. Remember, we're long 3 VIX calls and 1 SPY call. So we're going to sell off one of the VIX calls to get down to 2-1, and that brings in 1340 credit. So that leaves us now, we're long 2 of the VIX 40 calls with the underlying at 53, so they're 13 points in the money. And we're long the SPY call, which is more or less just slightly out of the money. But now implied volatility is so high that even an out of the money SPY call has a pretty big delta. Let's see, a couple of days later, VIX still exploding. VIX is now 82. The March futures are 72, still a 10-point discount. This is Monday the 16th. These futures are going to settle on the AM settlement on the 18th. Last trading day is the 17th, and it still has this huge discount. And so we're trying to still position ourselves to take advantage of this discount. We're marking up great on this trade now. So we're going to roll all these VIX calls up. We were in the 40 strike. We're going to roll the whole thing up to the 62.5 calls. That's a $20 credit on each roll. We're still on 2 of those. And we're going to dump the SPY calls. So now we're just playing the hedge for the last day, the 10-point discount for the last day. So this leaves us now long 2, March 62.5 calls with the underlying trading at 72, but the settlement index is 82. So we're hoping that at least it can hold this level for one more day. Well, as it turned out the next day, the discount started to shrink, got back to 7, and you can see, I'm just going to reverse up one slide for a second. You can see the futures here were at 72. Now they went to 69, and we're just straight out long these calls, and the discount's now down to 7. And we say, you know what, let's just dump these calls. We get out, we sell the last calls for 13. So we made $6,100 on this trade. And remember, our initial investment, I think, was $36.50. So pretty good trade. Just in case you want to know what happened, the next morning, the VRO settlement was at 69.76. So VIX came collapsing down. The futures really didn't move. They settled at 69.76. And that VIX 62.5 call that we had would now be settling at the difference here, $7.26 in the money. We sold out our last ones at 13 the day before. So that's why I told you, you really don't want to go for the settlement. Crazy things happen. You never know which way the settlement's going to go. So that's the trade. What can possibly go wrong in this trade? And there's always things that can go wrong. There can be a divergence. In other words, the market goes down and VIX goes down. Market goes up and VIX goes up. I mean, those things can happen. Also, if you're long those SPY calls and the market goes up, VIX declines. So that means your implied volatility of your SPY calls is dropping. So sometimes it's like a salmon swimming upstream on that first rally. And the other thing is you can get lazy on this thing and not adjust. You saw we did a lot of adjusting. It needs attention. I wouldn't say constant attention. We didn't trade it 10 times a day, but we did pay attention to it a lot. So, right now it doesn't set up because there's not a big enough discount on the front month Vix futures. I think right now it's like 1 point, but it will happen again. And you need to have this in your arsenal. I would say when the front month VIX futures get out to maybe 3 points discount, then you can start putting this trade on. Just to remind you, we're offering our flagship newsletter, The Option Strategist, to you free for 30 days. Just go to optionstrategist.com/TP free. And they may have put a link up for you here somewhere also just to click on it, but that will get you in. As I mentioned, we had these trades in this newsletter. This newsletter had, I'm saying, this newsletter is a low-cost newsletter. We had tens of thousands of dollars profits just on those volatility trades this year. So I think well worth it. We also have a YouTube channel. I invite you to visit that. I record a market comment every Monday morning. And we also have Saturday webinars once a month where we have chat. You can ask questions. We talk about the market, talk about an option topic or what have you. So that's going to wind it up for me. Were there questions, Raleigh, that you had there?
Yeah, absolutely. Wow, what a fantastic presentation, Larry.
It's like drinking from a fire hose, right?
I tell you what, there's a saying that you should respect more what you don't know than what you do know. I'm clearly in that mode right now.
Mm-hmm. Well, you know, VIX futures and options is not an easy topic, but if you understand, you can make a lot of money. But if you're in them and you don't understand, you can lose a lot of money.
Very, very apparent to me, and particularly once again, just watching and having you share how you navigated through these trades. These are not fire and forget trades. These are trades, and you have your eye on an objective. I mean, there's so many things that I'd like to comment on with regard to your presentation, but there are a few questions I want to make sure I get to them. Let's see here. Does the VIX SPY ratio of 2 to 1 still apply in today's market? That was several people asked that question.
Yes, so it's running almost exactly at 2 to 1 right now. But you know that formula is in there. You can calculate it for yourself. And I mentioned if you go to our website and click on volatility data, free, and then free volatility data, you can get the historical volatilities of both SPX and the VIX futures.
Sure.
And calculate the formula yourself.
Sure. Another couple of questions that I'm kind of clustering this. When you roll or sell calls, do you try to maintain delta neutral on the trade, or do you recalculate that ratio each time?
So we're a little bit of both, but yes, if the delta gets too much out of whack, that's definitely a sign for us to roll, because I want that hedge to be there. I don't really in this trade, because the discount was so big all the time. I wanted to just maintain a neutral position, because I knew that discount would work in our favor.
Wow. Okay. Terrific. Another question here. Interesting one. Why are the October VIX futures at such a premium? Is the election really more bearish than anything we've seen recently?
Yeah, that's a good question. Yeah, so someone went and looked up the term structure. if you go and look in the term structure on the CBOE website, you'll see that they all go down in price until you get to October. There's an upward blip and then back down again. And I'd have to say that's probably right. There are a little bit of predicting is going on there within the confines of the term structure. Also, I should say that in markets that crash, the next October is usually not a very good month. So I would say that September, October this year is a time to watch out for, anyways.
Yeah, outstanding. And last question here, because we really hit the value of time is compressed on us here, Larry.
Sure.
But the last one is, so I guess this kind of wraps up. So shortening volatility using long VIX puts a defined risk trade. That correct?
So with shorting volatility,
using long VIX puts is a defined risk trade.
Oh yes, right. So yeah, in fact, with VIX this high, if you had any kind of buy signals on the market, you could either buy SPY calls, which are very expensive, or you could buy VXX puts, which are somewhat expensive. But if you're right on the market and the market continues higher, VIX in theory would go lower. So
okay.
Yes.
Great. Well, Larry, once again, thank you so much for your time today. Really do appreciate your presentation and the time that you took to put that together with us here. Delighted to have you with us, and we hope that you have a tremendous day.
Okay, you too. Thanks.